much for the opportunity to connect with you guys. My name is Caroline Weatherill. I graduated from Eckerd in 2011, majored in international business, double minor Spanish psychology. Really excited to be joining you guys today to talk about budgeting, which, while it may not be the most exciting topic, I get excited about it because I think back to when I was in your shoes and you guys are starting fresh. You're starting with a blank page. You're going to be going out, getting your first jobs, getting your first apartments. So now is the perfect time to, take the right first step, right? Build some good, healthy habits that's going to set you up for success in the long run. Before we get into specifics and what we're going to talk about today, just a little bit about myself. Like I said, I graduated from Eckerd in 2011. I grew up in New Hampshire prior to coming to Eckerd. After I graduated from Eckerd, I actually worked for the college for 3 years. I was an admission counselor, which I always say was the best first job anyone could ever have, getting to travel the country and talk about, a great place that Eckerd is. So that was wonderful. And then from there, I went back to school. I went to go get my MBA from Simmons University in Boston. And the traditional MBA path, typically people will intern in between their first and second year of business school, which I did. Had no idea what the heck I wanted to do. And in a lot of ways, I still don't know what I want to do. But I ended up interning for Bank of America. Went out on a whim, didn't have any particular interest in going into banking, but I Googled good companies to work for and Bank of America popped up and the rest is history. So after graduating from business school, I went to go work for the bank full time. It was a 2-year leadership development rotational program that I joined. And now it's been about 6 years that I've been with the bank. Really enjoy it. Currently I am a senior digital manager. So I oversee how we're training and coaching all of our client-facing associates on the digital capabilities, tools, resources that Bank of America creates. So basically everything within your mobile app or online banking, and just making sure that our teammates, they're able to speak to our capabilities and that they can educate clients that they meet with on how to bank digitally with us. So that's a little bit about me. I like sharing my story because I think back to when I was in your shoes and it's kind of like blank open space, right? You could go anywhere. And sometimes I think hearing other people's stories and how they get to where they are now helps kind of think about where you might want to go next or the paths you could take. There's no right or wrong way to get there. So just wanted to share that with you. So again, looking forward to talk about budgeting today. Topics for today, we've got a few agenda items, defining and creating a budget techniques, how to track your budget, examples of a budget. That said, I really want to keep this informal. So as we go, stop me, ask questions. We don't have to wait to the end for Q&A. I did sprinkle in a few polling questions just so we can be thinking about some stuff within here. But feel free to chime in. I really want to make sure that you guys get out of this what it is that you're looking for. And really, before we jump in, the main thing that I'll just call out is, creating a budget is something that's incredibly personal. Everyone has their own level of risk tolerance or their own journey of how they manage their money, what they're comfortable with. So there's not going to be a one size fits all, but I think a lot of the content that's in here, what's really great is it just, again, trying to set you up for success, build some healthy habits when we think about our money and how we manage it. All right. So Maddie, we can go to the next slide. And to kick us off, we're going to start with a polling question. Like I said, want to keep this informal, want to make sure we cover off on everything. Given the agenda topics we just went through, is there anything you guys want to make sure coming into this session that you want to make sure we talk about? And if the answer is no, that's okay. But I think for a lot of people that join a session like budgeting, there's probably something top of mind that they're hoping to get out of it. All right, well, hearing none, we'll continue. Like I said, chime in as we go. Any questions, anything you want to talk more about, happy to do it. So to kick us off, we're going to start with defining what a budget is and how you go about creating one. So if we go to the next slide, what is a budget? Couple just, definitions, if you will. It's a monthly plan of your expected income and expected expenses. It allows you to track your spending so that you can better manage and save for everyday life and your goals. The key thing when I think of a budget is that it's a plan, and plans don't always work out the way you want it to, and you adjust your plan as you go. So the key with a budget is doing your research, make sure that you're setting up a realistic plan or budget in this case. And as things go, you adjust. There's no right or wrong way to it. And also things are going to change over time as you progress throughout your careers, as you move to different cities, live in different places, what have you. So a budget isn't going to be a one-time, one size fits all. It's something that again, building those healthy habits of how to find a budget that works for you and meets your needs, and then updating and maintaining it as you move forward. All right, we can go to the next slide. So again, when we think about a budget, it's essentially money coming in, money going out, right? So when we think about money coming in, that's our income. There's a lot of different ways we can have money coming in. Obviously, our job and the money we earn at our jobs is probably our primary source of income, but there's other ways to be earning money too, right? We could have a side gig or a side hustle, business, investment incomes. We're going to talk a little bit about investments, but passive income where you're not really doing a lot, but you're getting, dividends or, whatever it may be of how you're getting some extra money coming in. So when we're thinking about a budget, it's important to look at it from a very, very high level at first, everything that's coming in. I mean, it could even be your parents are still, paying for your car or something, right? That's still income that you have coming in that you want to account for when you set up a budget. The other thing I'll say too is a lot of people, especially once you get out and you get in the workforce, they see their income as the money I earn from my job, that's it. And what's interesting is I read this recently. A millionaire's average number of sources of income is 7 different streams of income. So don't go through this unilateral view of it's just my job. I need to get a higher paying job and be making more money in my job. There's a lot of different ways to be earning money to beef up that income so you have more to work with when you're creating your budget. All right, so we can go to the next slide. Expenses. So if income is money coming in, expenses is your money going out, right? And when we think about expenses, we can really break it down into 2 ways, right? There's your fixed expenses, and then there are your variable expenses. Fixed are the ones that, same amount every month, or not even month, right? But same pay period. So it's expected, what you're getting. It could be annual, it could be biannual, doesn't have to be monthly. Variable, these are the ones that are likely to fluctuate over time. So things like going to the grocery store or how much you're going out to dinner that week, things like that. I'd also add in here though, oh, sorry, Maddie, we can go back to this one, that while there's fixed and variable, there's also expected and unexpected. And we don't have it called out here, but expected are the ones that we plan for, right? That would be our fixed and our variable that we know about. But unexpected are the ones that, quite frankly, can get us into trouble if we don't think about it when we're setting up our budget. So that's where building a budget with the primary goal or end solution being to have a savings or a cushion somewhere built in helps solve for those unexpected expenses, because that is something we always need to keep an eye out for. All right, we can flip to the next one. Okay, so again, these are just some examples here, right? Fixed expenses, these are ones that same amount every time, we know what to expect. Couple things I'd call out when we think about fixed expenses. Just because it's fixed doesn't mean you don't have control over deciding how much you're going to pay. It just means it's the same amount every pay period. And a great example of this is car insurance. So when you insure your car, a lot of insurance companies, they will offer you two different plans. You can do one plan where, say, you're paying $75 a month every single month. That's a fixed expense. Or you can pay, and I'm not going to do the math, but you could pay a lump sum twice a year. But when you divide that by 6 months, so the lump sum broken out if you were to have paid it each month, and that lump sum ends up being only $60 a month. If you budget it and plan it out right, do the lump sum that you're paying only twice a year. So yes, you are paying a few $100 at one time, but it ends up being less month over month. And if you build it out into your budget and you sock away that, say it's $60 instead of $75, you put away that $60 each month. Now you have that all packaged up, ready to go when the bill comes due twice a year. So still fixed, but you have some control as far as how far you're willing to plan to actually save yourself a little bit of money. And so again, doing your homework, decide what you're comfortable with. This is where building a budget gets so personal, right? Like for some people, going out to eat and having dinner with their friends is really important to them. So they know that their variable expenses need to be a little bit higher. They're willing to shave off and keep some of their fixed expenses as low as possible. Even things like rent in a cheaper place or living with more roommates so that they have more money available for those variable expenses, just as an example. Totally personal, but doing your homework to know how much things could cost. And, if you go with this service provider versus that service provider, keeping track of your subscriptions. If you're not using one after 3 months, probably worth just canceling it. Because oftentimes our fixed incomes, they tend to turn into the set it and forget it. And that can get us in trouble later down the line too. So that's a little bit about fixed expenses. Let me pause here. Any questions so far? Okay, we can move to variable then. So this slide, again, just some examples of variable expenses. These are the ones that tend to fluctuate the most. And if we're keeping track of our budget, we're, are we on track? Are we over? Are we under this month? These are the ones that are probably the easiest to cut back on, or quite frankly, we're most likely to splurge on if we're doing really well to make sure that we're staying in line with our budget. And these are also the ones where it gets a little bit more tricky when we're setting up a budget to estimate how much we should be setting aside for each one. We'll get into that in a little bit, but this is where, doing your research. But in this case, our research is more of, rather than researching different subscription plans for internet providers, looking at our bank statements. How much are we typically spending at Publix right now? Could we shave that down a little bit? Is that something that's important to us? You still need to do homework, just in a different way when we think about our variable expenses. All right, we can go to the next slide. Okay, so budgeting techniques and tracking your budget. We can go to the next slide. The main thing I'll call out here is there are a lot of different ways to set up a budget. Again, there's no right or wrong way to do it, as long as you find a method that works for you and you're going to stay on top of it and track it. Something I'd mention here, and we'll go through, there's a couple examples that we have outlined here, but one thing I'll say is there are so many resources available now. Susie Orman, David Ramsey, some really well-known, budgeting people out there that have their own rule of thumb, guidance, what have you when it comes to setting up a budget and managing your money. So we'll go through these, but again, encourage you guys to do your own research, go out, listen to some podcasts, find something that works for you. And again, the key is finding a budget that you're going to stick to. So the first one here, this is a pretty standard one that you hear a lot. They call it the 50-30-20 rule. So 50% of your income is going to the things that you absolutely need just to function and survive. So things like food, where you're going to live, transportation, things that you absolutely need to function. 30% will then go to the things that you want. These are more of like those variable expenses where, you know, you have some flexibility. So things like shopping, you need a new wardrobe for your first job. You could go to a high-end designer, but you could also go to Target, right? So a little bit of fluctuation here, flexibility, I should say, with that 30%, but these are things that you want. And excuse me, the last 20%, these go to your savings. And savings within itself needs to be budgeted out in a few different ways, right? But you have what we're calling your cash reserve. So how much cash you want to keep on hand, but also planning for retirement or investments through a brokerage account, saving up for a side business, big purchases, goals, what have you. 20% of your income targeted towards those goals there. Next slide. Actually, you know what? I want to go back to that for just a second. Because we started talking about retirement and investments, and there's a slide on here we'll get into a little bit more, but as you're thinking about this 20%, again, this is where it all becomes a little arbitrary. You know, do what makes the most sense for you. You might want to shave this to be more of like 50, 25, 25 and go a little bit heavier on the saving side. Because when you're all coming out of college, right? Getting your first jobs, getting your first apartments and whatever it may be. But at 22 years old, the biggest thing that you guys have on your side when it comes to retirement and investments, which may seem so far off at this point in your life, you guys have time on your side. And I can't emphasize enough the value of compound interest, where it doesn't take a whole lot of extra work and it doesn't take a ton of money, but just the value of time to really capitalize on the investments that you're making now is going to set you up for success in the long run. Even if it's just $50 a month, right? To go into a retirement account or to go into a brokerage account, whatever it may be. Compound interest, it works in a couple ways. You have one, just the value of what you're investing in. So if you buy stock in a company, the economy is only going to go up. I mean, it might fluctuate up and down, you know, month over month, couple of years here, you hit a pandemic and it nosedives. But when we're talking about long-term longevity here, 20, 30 years, the economy only goes up. So investing $5 in a company today is going to be worth more than that 20, 30 years than now. So that's the first way that time plays to your benefit. But in addition to that, depending on what you invest in, if you invest in a stock that, you know, pays a good dividend, meaning that they pay you a little bit of money for every share that you own in that company, and then you use that dividends rather than putting it in your wallet and spending it, but just, you know, keep it in your brokerage account and reinvest it. Now you've started a snowball effect. So you have even more money that you're adding to the pool that's growing over time and over time. So compound interest, again, with that 20% savings, can't emphasize that enough. Really, really important. And don't think that retirement is that far away, because the habits that you build now and the actions you take now are going to set you up for success later down the line. All right, so that's the 50, 30, 20 rule. The next method is pay yourself first. And if I were in all of your shoes, quite frankly, and I was starting fresh, straight out of college, this is probably how I would go about setting up my budget. So this budget, it's really good if you have specific goals that you're trying to achieve. You want to build an emergency savings fund, you want to travel, buy a car, whatever it may be. But it's also good when you're starting on a blank page, right? You don't have any existing major expenses today. You can really shape whatever budget you want based on the income that you're able to bring in. And the reason why this is so great is because it lets you decide, if you set with your savings goal first, how much you can truly, really afford for rent. How much do you really want to put towards buying that new car? Because when you put the savings goal first and you let the housing and everything else trickle out from there, it it makes sure that you're living not just within your means, but below your means. And when you live below your means, it means you have more money and more assets to do the things you want in life. So that's just, another method here, right? Pay yourself first, making sure you're saving up enough money for those goals. There's not a set amount, right? Totally personalized what that means for you. But think about it, right? I mean, these are two different rules of, thought of how you can approach a budget. And quite frankly, you might want to do a combination of both or something different. But these are two very common methods when we think about budgeting and how to set one up. Any questions here? All right, and we can flip to the next slide. I think we actually have a polling question next. So just curious, right? I think for most of us, right, or most of you all, you're probably, living in the dorms or living on campus. Maybe some folks are off campus, but you still have expenses of some sort that you're paying for today, right? Going out to dinner with friends, going to the bar, going wherever, right? You're still spending money. How are you tracking your spending and savings today? Is anyone willing to share?
I hope for the best.
Yeah, that's one approach. Looking at my credit card spending analyzer. Awesome. We're going to talk a little bit about that in a minute, but that's awesome. That's a great way to track it. Yeah, hoping, wishing, praying. I hear you there. I remember that well, but this session is about building healthy habits and knowing ways that we can set ourselves up for success. So rather than just keeping our fingers crossed, there are a few ways we can make sure that we're tracking it. And it doesn't have to be the old school way that our parents and grandparents did it by pulling out their checkbook and reading every check that they, cash that month and, where's my money going? The great thing about banking in today's day and age is it's all electronic. So all we have to do is log into our banking app and all the information's right there. It makes life super easy. So we can go to the next question, or excuse me, the next slide here. And that kind of brings us to how we can be tracking our money. So some people, they like using the Excel method. They build out their customized budget. They can track the money right in there. Other people, they like using, the third-party apps, Mint, EveryDollar, that kind of, does the work for you. Bank apps, personally for me, bank apps, that's where I would be starting because there's so much information in there, and most banking apps have saving or budgeting features within it that can show you what categories most of your money is going to. And even just at a very high level, even if you're not setting up a budget, just to flip through there and realize like, whoa, I spent how much money at the bar last month? Like, I got to rein it in. Like, I can't, it's good just to be aware of where your money's going. And being able to do that all within your banking app makes things super easy. But you can also just use your bank statements too. Bank statements have a lot of great information within there. So again, the great thing, banks will do a lot of this work for you, right? Even if it's like a local, credit union, all the way to the big banks, Bank of America being one of them, all of them have the capability to be tracking your money because it's all data analytics, right? All of them have these tools and resources available. So I'd recommend playing around in your mobile app, seeing, what features are available, what it looks like there. And quite frankly, I would recommend starting there versus using a third-party app. And this is where I'm going to go a little bit on my soapbox working for a bank in the digital space. But using third-party apps, you have to be super, super careful because these fintech firms, while super user-friendly, super great and helpful, essentially when you sign up for something, even things like Venmo or Mint or something like that, when you sync your bank account in there, it's giving this third party direct access to your bank account. It's basically like sharing your password with a friend, right? And when you do that, a lot of these fintech firms, they are not what's called FDIC insured, meaning that if your money were to disappear overnight, a hacker were to, somehow access your account and pull your money out, they're not insured. Therefore, they're not required to necessarily put your money back in there. So you have to be really careful who you're giving your information to, making sure that they're very reliable, that they are going to help you. And quite frankly, a lot of the big banks, and not just the big banks, the smaller banks too, have invested so much time and money to get their platforms to provide the same services, if not better, than these third parties, so that you can do it all within your account. It's safe. You don't have to worry about, third parties or other parties accessing the information. That said, they definitely serve a purpose. The main thing I would just call out here is if you are going to use a third party, do your research, make sure that you're choosing a reliable one, something that is going to protect you if somehow it gets hacked in some way, shape, or form. All right, we can go to the next slide. So now we're going to get into some examples of what a budget could look like. So we can go to the next one. So this one here, as you can see, this one's done in Excel, right? So a lot more manual, because you're going to be manually putting in what you are spending for each thing month over month here. But what's great about it is it allows you to see how close you stayed within the budget that you set up for yourself. Where did you go over? Where were you under? So that you're able to adjust for the future. And that's great. It's helpful because, again, with budgets, it's never going to be like a standard form that's going to stay that way forever. Budgets are going to change over time, especially right now where the way inflation's going. Like, you got to update your budgets because the cost of things are going to change over time. You're also likely to get promotions, get new jobs, and be earning more money that you need to update in your budget. So making sure that you're going back in, you're revisiting your budget. If it's not every month, every few months, just making sure that you're on target, but also that what you're estimating for each line item in your budget is realistic with where you really are and where you need to be. The other thing I'll call out too, rookie mistake when setting up your first budget, is making sure that that monthly income line at the top there where it says 3,000, make sure the number that you're starting off with for your income and the money that you're working with is income after taxes. So don't think, great, first job out of the gate, I'm making $60,000 a year, divide by 12, here's my monthly income. No, you got to account for taxes, both federal, state, money that you're leaving out for your retirement. There's a lot of money that's going to come out before you even have your leftover amount to start with everything that you're going to be paying for with these expenses here. So best way to get that information, go to your pay stub, go to your checking account, see how much you're actually getting a deposit for every month, and starting there when you build out your budget. And that's really regardless of what budget you build out here. Okay, we can go to the next slide. All right, so just a second example here. This one you can see is much more of the pay yourself first method that we talked about, right? So this one, they're starting with money going into their retirement account and their savings account, and then everything kind of trickles out from there when they think about those variable expenses and everything coming out there. Again, you can personalize this, find something that works best for you. These are just two very generic examples. You can go to Google and Google budget templates, and there are a million of them. So just find something that works for you. But again, mobile apps, whether it's through your bank, third party, they'll feed all that information right in there for you. There's a lot of really great resources out there to keep this super easy. The main thing is that you're going to go in, check it, monitor your spending, and update as you need to over time. Any questions here? All right, let's go to the next slide. So financial planning goals. We can go to the next slide here. So financial planning goals, quite simply, I would put this as just planning a little bit, right? Like, what are those big ticket items that you know you're going to need or want, for that matter, that you need to be working towards? And this could be anything, right? So, like retirement, sure, but down payment for a house, say I want to make sure that I go on one nice vacation every year. That would be a planning goal. Needing, knowing 3 years down the line, I'm probably going to need a new car. Saving for a new car is one of my saving goals. It could literally be anything that you want to save or work towards, but you're going to need a lump sum of cash to be able to afford. At the same time, it could also be just general building your net worth, just asset growth in general. So it's just saving money as a whole when we say financial planning goals. There's a lot of different ways you could break this down. Here we're breaking it down between savings and investments. Savings, when we think about what we call our cash reserves, think of this is the cash you want to keep on hand, right? So opening up a savings account, putting your money in there. Think of these as like short-term goals that you want to achieve within the next couple years. So buying car, saving for a trip, what have you. Also an emergency fund. General rule of thumb for an emergency fund is you try to get to $1,000 first for an emergency fund. And then once you hit $1,000, try to grow that to somewhere between 3 and 6 months of all of your living expenses, essentially, right? So like, what is your budget for 1 month of everything that it costs you? Multiply that anywhere between 3 and 6 months. That's your emergency fund. So if, God forbid, you lose your job, something happens, you have money to fall back on so you don't have to go into debt. That emergency fund should be off to the side and be totally separate from the savings that you have for everything else, for saving up for large purchases, what have you. But this cash reserve, again, money that you're going to need to have or plan on spending within the next couple years. Anything more than that, that's when you can start thinking about doing something else with it, more like the investment side of things, which we'll get into in a moment. What I'll say here, though, when we think about savings accounts in particular, or bonds even, they're the safest, they're the least riskiest, and this is more savings account than, well, bonds too. Your money isn't really working for you. So the great thing about investments, which we'll get into, is you put the money in and your money's working for you. It can earn a little extra income. It's growing in value. When you put money in a savings account, even with the interest rates starting to rise today, you're still not earning that much on how much you have in there. The only way that money is going to grow is if you keep adding to it. So it's safe, it's liquid meaning you could pull it out at any time if you need it. But it isn't necessarily doing a lot for you. So that's why again, once you hit a certain threshold, and it's different for everyone, whatever you're comfortable with, that's when you start to transition to more of investments in any number way, shape or form there. But it is important to have a good cash reserve on hand to pay for those unexpected expenses, planned expenses, those goals that you have, and again, that emergency fund that you need. Retirement, this is in the savings bucket. I would put it more in its own bucket, or maybe investments even, because a lot of it is in individual stocks or mutual funds, what have you. Retirement, there's essentially two different types of retirement funds. So there's the employer 401k. This is something that your company would offer. So when you start your first job, one of the questions you want to ask is, do you offer a 401k program? Essentially, within your 401k, that is money that you're putting in that's planned for your retirement. And you're a little bit more limited on what you can actually invest it in, but it's a lot of index funds, enough options where you can really kind of plan out, or excuse me, not index funds, targeted funds, I should say, where you can really plan out, have some options of how you want to put that money in. Again, investing, right? And the other thing to call out about 401ks is that oftentimes companies offer what's called a company match. So say, if you contribute 5% of your salary to your 401k for your retirement, and the company has a 5% match, that means up to 5% of your salary that you put in, they will also put in 5% of your salary to that retirement account. So great guidance here is when you start your new job, do they offer a 401k, and what is their company match if they do offer one? And make sure that you're contributing at least up to that company match, because otherwise you're basically walking away from free money. We all need a plan for retirement. Pension funds aren't really a thing anymore unless you're working in some areas of the public sector. So making sure that you're putting money into a 401k if it's offered, and you're taking advantage of that company match at the bare minimum, really important. In addition to 401ks, again, offered through some companies, there is what's called an IRA account, or you'll hear it as IRA sometimes too. That's an individual retirement account. And this is something you can open up essentially at any brokerage firm. So you can go to Fidelity, Charles Schwab, Merrill Lynch, what have you. You open up an IRA, and there's two different types. There's a Roth and there's a traditional. And I should call out, there's also Roth and traditional for your employer 401k as well. Roth and traditional, basically what it boils down to is your tax advantage and how you put it together. So for example, the Roth account, you pay the taxes now and your money grows exponentially. You don't have to pay taxes on it when it comes time to actually pull that money out. Traditional is the reverse of that. So you don't pay taxes on it now, and you pay the taxes when you go to pull that money out. Both have pros and cons to it. Again, I would recommend do your research. There's a lot of great podcasts, information out there. But I'd also say go talk to a financial advisor. Even at 22 years old, great time to be setting up and making sure that you're on the right path here. But essentially, with both, pros and cons to both, really the advantage to the traditional is you're limiting your taxable income now, right? So say you make $70,000, you put 20 into a traditional, 401k, or you could even do that plus an IRA if you wanted to. That means you're going to be taxed $20,000 less of what you've earned when it comes time to paying your taxes now. So you actually get more money back when you file your taxes, right? So you can use that money now for other things. Versus Roth, you pay that all now, but you're gonna have that all essentially free money, right? You don't have to pay taxes on it. You know exactly what you have for retirement when it comes time to actually use that money. And a lot of people will actually do a combination of both. No one knows what the tax brackets are going to be, 30, 40 years from now. So if you do a combination of both traditional and Roth, it helps diversify and set you up for success in that way. Let me pause there and see if there's any questions, because I know this is where we start to get a little deep and a little complicated. Any questions about retirement or cash savings? Okay. Again, even I remember getting my first job and feeling like absolutely silly to be talking to a financial advisor at 22 years old. Like I, don't have any money, but I just want to set a plan in place. They truly are the best people to be going and seeing, because they can help set you up for success and talk about, the type of life you want to live, where you are right now, who your employer is, all of those factors, and help you figure out how to piece it together, what makes the most sense. The second piece of this is investments. And investments, and when we talk about investments, a lot of times you'll hear about passive income. So passive income meaning money that you earn without actually having to do a whole lot of work. It's basically money earning money for itself. There's a lot of ways you could do this. You can buy individual stocks or bonds, mutual funds, index funds, ETFs, but it also could be real estate. You could, buy some apartment buildings. You could get into cryptocurrency. There's a number of different ways that you can get into investments. The main thing when it comes to investments, though, is you can earn a lot of money, but it technically is risky, right? So it's not guaranteed. You can lose some of your investments. But again, the great thing for you guys being so young is that you have time on your side to be taking advantage of this compound interest that you have. So definitely still something, even though risky and you likely don't have a ton of extra cash on hand at this time, great thing to try to prioritize, even if just a little bit, to be building that nest egg over time. So just some details here. Individual stocks and bonds. This is where you're buying into a piece of one individual company. The main thing I'd say here is make sure that you're reading up on the company's financials. If you don't know how to read company financials, a lot of brokerage firms, so the Fidelities and Schwabs of the world, they will have a lot of research information right in there. You can go to Yahoo Finance and find what the key things are that are important to you. So things like dividend yield, earnings per share. When you think about your individual investment plan, what are those key metrics that are important to you for deciding what type of company you want to invest in? There's also a lot of great resources out there that give the guidance of, hey, check out these top, tech companies or these companies, whatever it may be. So things like Motley Fool, IQ Trends. Some of these are more subscription services, so they do cost some money because of the guidance that they're providing, but it makes it an easier way to get into the stock market, invest in a few key companies, and make educated decisions without having to go through every single company's, financial, balance sheets and everything from that standpoint to decide whether or not it's a good investment. So that's individual stocks and bonds from that standpoint. The other one that was called out, mutual funds, ETFs, index funds, all that, they're all slightly different, but essentially, just to boil it down, is they allow you to purchase a basket or a group of assets. So think diversified assets, right? Because the saying goes, you don't want to put all your eggs in one basket. That's financing or investing 101, right? You don't want to go all into one company because what if that company tanks? So if you invest in a mutual fund or an index fund or an ETF or any of these sort of things, you're buying a basket of them, but you don't have to individually pick out what those companies are that you're investing in. Someone's doing the work already for you. Mutual funds, those typically tend to be more actively managed. So an individual is actually deciding which stocks to actually put in the basket. ETFs tend to be more automated. Index funds are basically following a market. So Standard & Poor's or S&P 500, if you've heard of that, NASDAQ, those types of things, they're following more the market as a whole. But again, the general rule of thumb is it's an easy way to get a diversified basket of stocks to be invested in without having to do all the legwork and research of individual companies. This, of course, comes at a little bit of a cost, so there is typically more of a fee associated with these. What that fee is, when you pay it, again, all kind of depends, but from a very high level, again, great way to get into less risky, more diversified, kind of, I don't want to say set it and forget it, but easier way to get into the investing arena. If you feel a little intimidated or not sure where to start, an index fund or mutual fund might be a great option to consider. And then lastly, real estate, crypto. What I'll say here is do your research, check out podcasts. The key to any investment, whether it's getting in the stock market, crypto, real estate, whatever it may be, find something that you're somewhat interested in, because this is your money. This is your investment. You need to be somewhat educated to where your money is going, because again, a lot of this stuff is somewhat risky. So you want to make sure that you're putting money into something that you know enough about to know when you need to get out of it. So that's, again, do your research, see different types of investments that you'd be interested in, and go from there. Let me stop there. Any questions? All right, so comment here. Back to savings. How should high yield savings accounts be managed? How much money should be put into those versus typical savings accounts that earn basically nothing? Really good question. So essentially, high yield savings accounts historically, typically, are through banks that you may not have heard of as much, although there are more common ones, like American Express has one right now, for example, or Ally Bank. But these are more, these are banks that typically aren't brick and mortar. You can't go into a location and talk to a live person. These are ones that have lower operating costs, which is why they're able to offer higher interest rates on the money that you're putting in. So in general, when it comes to setting up a high yield savings account, I would recommend doing your research, read reviews, make sure it's a company that they like. Most high yield savings accounts and regular savings accounts of your local bank that you're going to, they are going to have a cap at how many times per month you can pull money out of that account. It's typically 9, but every financial institution is a little bit different. As far as which one to use for when, really doesn't make that big of a difference. A lot of people prefer just a regular savings accounts just for the ease and convenience of it, because it's tied to their checking account. Everything's all at one bank. I can easily see it within one app. High yield savings account, another company, have to go out of my way to look at it. So it's typically that ease and convenience with a regular savings account. High yield savings account, there's really no maximum. Again, I think it goes back to your comfort level of how much cash you want to have on hand versus, okay, I'm comfortable with my nest egg. I'm ready to start investing the rest of it into the stock market or something else that you might be interested in. Does that help? Or any follow-up questions there? Okay, great. Any other questions? Or quite frankly, I think that was the last slide. Anything else that you guys want to talk about? No? Okay. Well, I'll tell you this. I remember being in your shoes not too long ago, and it's scary. I think probably my transition out of Eckerd into the real world was one of the hardest transitions I ever went through. And I think this series is fantastic and setting you up for success. But the other thing that really helped me through is just knowing that the Eckerd community has your back to help you with that transition. And the alumni network is just as strong as, you know, the actual campus network that you have too. So please don't hesitate to reach out to myself. I know Grant has a great network of alums that you can reach out to. You know, you can find me on LinkedIn or get my information from Maddie or Grant. Happy to connect as a one-off and talk through things, whether it's about budgeting or anything else for that matter. But it's been a pleasure connecting with all of you, and hopefully this was helpful. And again, I wish you guys all the best.